can see a few people starting to join, so we might just wait a couple of minutes until 12 o'clock and then we'll make a start. All right, well, we might make a start. It's 12 o'clock and quite a few people have joined us. I'm sure there'll be more that join along the way. So welcome everybody to the third session of our 7-week seminar series of Lunchtime is Money, a bit of a play on words there. Today, Pierce and I are looking forward to sharing some insights with you and answering any of your questions as you spend your lunchtime with us. Over the series, the advice team at Hewison Private Wealth will be delivering all you need to know on topics like asset allocation, rebalancing, income, philanthropy, as well as question and answer series with a number of investment managers. Today's session will run for around 45 minutes, including question and answer time, so we won't hold you up for long, just so you can enjoy your lunch break. We will try to answer questions throughout the presentation, so feel free to place a question in the box and we'll try and answer it as we go along, or we'll leave it till the end. We've been very pleased with the support for this seminar series, and today we're joined by a number of clients, prospective clients, colleagues and professional contacts. We hope this series helps you manage your finances better and increases financial literacy. For those that don't know me, my name is Simon Curtin. I'm a Director and Private Client Advisor at Hewison Private Wealth and have been with the company for around 14 years advising a number of clients. I'm joined today with Pierce Hanlen.
Thanks, Simon. So as mentioned, my name is Pierce Hanlen. I'm a Private Client Advisor here with Hewison's, and I've been with Hewison's for about 4.5 years now, and some of the things that really attracted me to Hewison's were they were fully independent, and we've got a great culture here as well. So yeah, very, very proud to be part of the team.
Great. So today's topic is called investing for income, and I'm sure anybody who's had anything to do with a Hewison Private Wealth Advisor has heard us espousing the benefits of income. We have a very strong income focus when investing, constructing portfolios, advising clients. We view income as an important aspect to portfolio design. Primarily because income is steady and reliable. While nobody can predict growth markets, nobody knows what the share market's going to do today, tomorrow, or next week. Property markets are also difficult to predict. We do find, however, that income is predictable, steady, reliable. And so if you make the portfolio, if you underpin the portfolio with steady and reliable income, it makes it much easier to construct portfolios, draw down on portfolios over a longer period of time. ideally, what we're looking to do when we construct portfolios or advise clients on constructing portfolios, really what we're looking to do is target income of around about 4 to 5%. So 4 to 5% income, and then of course you're getting your capital growth. The capital growth is important because that's what helps you grow your asset base over time and particularly protect against the effects of inflation. We're not focusing too much on capital growth in this presentation. This presentation is all about the income, how income's generated, so that in an ideal situation, your asset base is generating steady, reliable income. You're using that income to fund your living needs, meet your goals and objectives, and then ideally you're leaving the capital base intact to grow over time and protect against inflation.
So before we have a quick look at what we're going to go through more specifically today, let's just start off with a little bit of a case study that we can come back to at the end as well, and just give you a bit more context around how it actually applies and what we sometimes see when a new client comes to us and the strategies we can build. So we look at Sam and Sue, and they're 63 and 61. They've been running their own business for quite a long time, but they've recently exited it, whether it's coronavirus impacted or not. And they've used the money that they got from selling that business to repay their debt. So they are entering retirement debt-free, which is great. They know they need about $60,000 every year to meet their ongoing living needs with a small holiday built in there. And something that's been a bit of a concern for them over time is they haven't actually been contributing to super, because all the money they've been generating in the business has just gone into growing the business with the view of selling it one day. So it is a concern for them. They don't really know what that means for them and if they should have super. They do, however, though, own 2 rental properties in southeast Melbourne. So they're both valued at around $750,000 each, or $1.5 million in total. And as I mentioned before, they've paid all the debt off from those properties as well. And the rental income they're getting from that is about $37,500 or 2.5%. So to date, how's that been as a strategy? Well, it's been really good. I mean, the properties have been in excellent locations and they've performed really well as residential properties, because the residential property market from a growth perspective has been really strong. And over time, they've actually got some negative gearing benefits from doing it that way as well, because they were using borrowed money to look at it. We do need to look at some of the risks that are posed to Sam and Sue though as well, which we will touch on a little bit later, and we'll look at what our strategy might be looking forward and what an income focused portfolio could mean. But to us, when we see this straight away, our main thought is they're generating $37,500, but they need $60,000. So where does that shortfall come from? So once again, what are we going to do today? We'll look at how we invest for income. So we're actually going to look at the different asset classes that we've used. So we try to simplify it as much as possible into 5 asset classes. You've got cash, which is cash, fixed interest, property, Australian shares, and international shares. They're our 5 broad asset classes. So we'll identify how each of those generate income. We'll look at how, once again, we can utilize diversifying across all of those asset classes to reduce risk and enhance income. It's a good rebalancing tool to generate income. We will look at the COVID-19 impact and what we're experiencing so far and what our gut feel is for the time going forward. And once again, we'll come back to some question and answer time as well.
Thanks, Pierce. So next step, we're going to be talking about how income is generated within a portfolio. Now we segment portfolios into 5 different asset classes: cash, fixed interest, property, shares, and international investments. So we're just going to step through each of those and really set the scene about how income is generated. And then of course, we'll be talking about how COVID-19 has had an impact, or if it has had an impact on an asset class's ability to generate income. The first asset class that I'm sure everybody's familiar with is cash, or cash and term deposits, often lumped in together. No surprises here. Cash is cash. Interest rates are at record lows, 0.25% in Australia. And so unsurprisingly, cash is providing a very low rate of return. Term deposits, not that much better. For cash and term deposits at the moment, you'd be expecting around 0.25% to a 1% income return. Security is paramount in this asset class. Cash isn't volatile. It doesn't go up. It doesn't go down. It retains its value. And because of the low risk nature of this asset class, you get a very low return. Fixed interest is another asset class that we often focus on. Fixed interest, like cash, is an income producing asset class. We don't expect any growth from the fixed interest sector of portfolios. We've broken the fixed interest asset class into a couple of subsectors because it just helps to highlight the differences within that sector. But I always like to think of fixed interest primarily as you, the investor, lending your money to another entity. So unlike share investments, which a lot of people might be familiar with, where you are actually investing your money in a company, you're actually becoming a part owner in that company and you get to share in the profits and the growth of that company over time. Fixed interest is arguably on the other side of the fence. This is where you are lending your money to another entity. That could be a large corporation, it could be a government, it could be the bank in the form of a term deposit, or it could be an individual. And depending on the creditworthiness, the riskiness of that particular borrower, that will dictate the expected return you can expect on your fixed interest asset. So the first sector that we're going to have a look at in the fixed interest space are secured first mortgages. And I'm sure many clients out there have heard the term secured first mortgages, probably have them within their portfolio as they often form quite a healthy segment of a client's fixed interest exposure. As I mentioned before, fixed interest investments are you, the investor, lending your money to another party. So in the case of a secured first mortgage, you are lending your money to another individual and they are securing that loan against a property, and it quite often might be their own property they live in. It might be an investment property. We typically look at secured first mortgage investments in Melbourne and Sydney because they really are the blue chip property markets in Australia. What makes these investments unique, however, is the security for the loan. So the particular borrower is offering their property as security. Now, I'm sure anybody who's tried to take out a loan with a bank knows that you often need a 20% deposit. You can perhaps even get a home loan with a 5% deposit or even a 10% deposit. Not so with the secured first mortgages that we look at, that we put forward for our clients to invest in. Really what we're looking for here is a high level of security. So the mortgage investments that we're investing in will have a maximum of a 67% lend, ideally around about a 60% lend. So what that means for our investors is there is a 40% buffer or 40% equity there that gives them a lot of protection and security over their loan. Now, the investments here, because they are lending to an individual backed by their property, as I said before, you would expect a slightly higher rate of return. 6 to 7% is typically what we're seeing at the moment for secured first mortgage investments. So these really are the engine room, if you would, of the income being generated by a portfolio, because they're quite high yielding investments. We don't expect any capital growth. If anything, we've got a lot of capital protection there, as I said before, with the 40% or so buffer, that if the mortgage investment did happen to get into trouble, ultimately a property would be sold to repay the loan, and that's really where the 60% loan to value ratio comes into play, because we want to make sure that our clients' money is secure when we're investing in the secured first mortgage space.
Thanks, Simon. So that now brings us to bonds, senior corporate debt, and hybrid securities. Now, I guess comparing these to secured first mortgages is really important, because we have had queries before, why don't we just invest in secured first mortgages if they're getting such a great rate of return and there is those healthy buffers there to protect clients? And the first one is risk. So, you know, we believe heavily in diversification, and you never want to put all your eggs in one basket. But the other reason as well is part of the reason why you're getting a great return from these secured first mortgage investments is because you are still locking your money away for a set period of time, similar to a term deposit. And we often find that the secured first mortgages are generally anywhere between normally 6 months to 24 months. So not an overly long period of time, but you're still locking the money away. So you still need to make sure that you have access to capital and, once again, reducing the risk by diversifying how you're investing in fixed interest. So let's start with investment grade bonds in Australia. As you can see there, the expected return from an Australian investment grade bond isn't overly high. It's better than cash and term deposits. But the reason for that is a large portion of this market is actually government debt. So bonds that are being issued by the Australian government, which has a really high credit rating, they're incredibly secure, and you have access to the capital quite quickly. So the trade-off there is a bit of an income return. So we really look to that portion of this part of the portfolio to be really, really capital secure and basically at our fingertips. So if we wanted to access some money out of the fixed interest portion, you can have your money within a few days if you sell that investment on market. Next, we look at senior corporate debt. The higher return indicates that you're taking on a bit more risk. What we're looking at senior corporate debt is, once again, as Simon mentioned earlier, with all fixed interest, you're still lending your money to someone else or something else, a company, and in return receiving your income. So senior corporate debt is the really large businesses around Australia, things like Woolworths and Telstra. So they also do raise money to continue business practices. And this is this area of the market. And the key word in that line is senior. So if we look over to the other side of the screen where it's titled Capital Structure Corporate, this gives us an indication of where you sit in the repayment ladder. And what I mean by that is if, now we obviously don't expect them to, but if a company does enter administration or liquidation and they have to start paying back debts because they're no longer a viable business, senior debt is repaid first. So once again, it's still very secure, but because it's not as secure as, say, lending money to a government, you do get a higher return. So we like to include senior corporate debt as well because it's a great diversifier and still provides great income too. We then look at hybrids, and a lot of our clients will have, or long-term clients will be very familiar with hybrids. We've been using them for a very long time. And once again, you get a slightly higher return from hybrids because there's an extra element added into hybrids where the capital value of the investment can sometimes be impacted by the value of the underlying issuer. So let's just say it was Commonwealth Bank that released a hybrid. If Commonwealth Bank hit a really rough patch and the value of Commonwealth Bank shares decreased a lot, the value of the hybrids can also follow that down as well. So there is a little bit more risk there. But because there is more risk, once again, we put our own measures in place, and a lot of businesses and a lot of companies will issue hybrids, but we just look at the major financial institutions in Australia that have very high credit ratings, that basically the main four banks and the likes of Macquarie. So once again, this bonds, corporate debt and hybrids is all about adding more diversification to the portfolio, still generating income, but all three of these investments are liquid. So they're traded on the stock exchange, which means you can sell them and you can have your money back within a few days.
Thanks, Pierce. So with the bonds, corporate debt, hybrids, secured first mortgages, that's the fixed interest sector or the fixed interest asset class that constitute a portfolio. As I said before, generally high yielding. We don't expect, we really don't expect any capital growth out of that sector. Shares, on the other hand, are more of a growth-orientated investment, and I'm sure everybody's seen the news almost nightly. The news reporters will tell us what's happened in the share market overnight, what's happening today. It really is news every day. We're not necessarily focusing too much today on the capital side of shares or Australian and international shares, where the share markets can go up and down. Really what we're looking at here is what income does the share portion of a portfolio provide. And investors receive income from shares through dividends. So as I said earlier in the presentation, when you're investing in shares, you're really taking a part ownership in the company. Now, it might be a very, very small part ownership, but you are still classified as an owner of the company. So when that company earns profits, it distributes its profits to its owners, and you as a shareholder receive It may be a very small share of the profit, but it still is a share of the profit, and that is what we call a dividend. So that's how shares generate their income. They'll have their capital side where the share price will go up and down, but then you'll also receive income on your share investments in the form of dividends. The other term there, which I'm sure many people are familiar with, are franking credits. Now, franking credits on their own could probably constitute a presentation, but at a top level, a franking credit is really recognising that the company that paid the dividend has already paid tax on that dividend. Now, you as the investor, when you receive the dividend, you receive a credit for the tax paid. So if you're a retiree, for example, and your tax rate is low, or perhaps even zero if you're in full retirement, often what you'll get is a refund of the franking credit because the company has paid tax on its dividend. You don't pay any tax, so the tax office effectively give you that tax back, and that's a franking credit or a refund of franking credit. Now, franking credits can be a really powerful income enhancing tool for a portfolio because you'll still get your income through the dividends, and then at tax time you might get a refund of franking credits, which can really boost the cash return or the income on a portfolio. As you can see there, for shares, both Australian and international shares, we'd expect to see around about a 3 to 4% income or dividend return. Generally speaking, international investments don't pay much dividends at all. It's kind of a quirk of the Australian market that we have such a strong focus on dividends. So when you're blending Australian and international investments in a portfolio within the share asset class, you'd expect to receive around 3 to 4% income. And then, of course, you're getting your capital growth over time.
Thanks, Simon. So that leaves property as an asset class now. So property we'll all obviously be very, very familiar with. And I guess before we jump into how we look at property and how we invest it to generate income, let's just quickly identify the differences between residential property and commercial property. So residential property, when we look at that from a return perspective, generally doesn't pay much income. You can expect normally around 2 to 3% as an income return from residential property. But that's okay because it's compensated with higher growth expectations. So as long as you hold the property for a long period of time, and it's a good property in a good location, you can expect that it's going to grow in capital value quite strong. Commercial property is a bit different. We don't expect as much capital growth. We still want the capital growth because it is a growth investment, but it's not as high as residential property generally. But once again, that's okay because it's compensated with higher levels of income generation. So it's quite reasonable to expect that from a commercial property. So what I'm talking about there is the likes of, it can be a factory, an industrial property, $150 million CBD building, a hotel. There's a huge range of commercial properties. They will generate typically anywhere between 4 and 7 or even 8% of income as well. So they are paying a lot of income. Now, the other thing that we like about commercial property is there's often built-in rental increases. So there might be part of the agreement with the tenant that over time, every year, there may be a, say, 3% increase in rental income. And that's really helpful because, as we know, over time, inflation basically means that our cost of living is just going to keep going up. So we need our income to increase steadily as well. Now, obviously, a normal investor is not going to be able to scrape together $150 million and go buy that building in the CBD. It's completely unrealistic. So how do we access it? And we use syndicated structures to do so. So instead of, once again, trying to find that $150 million, what you can do is pool your money with other investors to gain access to properties like that. So kind of like what Simon was saying before with the company, instead of owning the company, you own a small part of it. You can also own a small part of a really high quality building with A-grade tenants that are excellent at paying their rental income, but you can do it in much smaller amounts. Now, what we often find is, let's just say, your portfolio had an allocation of a couple of $100,000 to property. Instead of saying, well, let's take that couple of $100,000 and put it just into one investment and hope it's the right one. Syndicated structures mean that you can actually include 4, 5, 6 and onwards different types of properties. So once again, you reduce your risk, you spread out where you're getting your income from, and you increase the diversification of your portfolio overall.
So that gives us a bit of an overview of how each of the respective asset classes generates its income. Perhaps the question on most people's minds is, well, how has COVID-19 impacted the income generated by a portfolio? It's a question we're often being asked by clients, because most people are hearing on the news the doom and the gloom, and we've seen the share markets suffer greatly over March and April, and somewhat of a recovery since then. A lot of speculation about what may or may not happen in the property market, but of course they're both capital issues, if you will, because share markets going up and down, property prices going up and down. Here we're focusing on the income. So what are we seeing, or what are we expecting to see the impact that COVID-19 will have on a portfolio, its ability to generate income? So we're just going to go through each of the asset classes again, now that we're a bit familiar with how they generate income. So using cash or cash and term deposits, as I said at the start of the presentation, interest rates at the moment are low. So too is the return on cash and term deposits. Now, we're not necessarily seeing COVID-19 impact the interest rate that a cash deposit might receive. However, we are seeing interest rates being kept low, and I suppose even looking forward, there's quite a bit of economic recovery that we're going to have to go through over the next period of time. So we can't foresee interest rates increasing. If anything, the Reserve Bank would most likely look to keep interest rates low for a longer period of time, which means that the cash return will continue to be low. So really not that much of an impact. Most portfolios won't hold a huge amount in cash. It's an important asset class for liquidity, giving a buffer, but you're not really relying on it anyway for a strong income return. The fixed interest asset class, however, that is the asset class that we really rely on for our strong, steady, reliable income. Lower interest rates also have an impact on a fixed interest investment's ability to generate income, as Pierce took us through before with our corporate bonds, our hybrids and the like. As an issuer, they're benefiting from lower interest rates, but us as investors, lower interest rates can often mean that the return on a bond or the return on a senior secured debt is a little bit lower. That's probably more a function of the investment cycle that we're in, with interest rates just being at record lows even before coronavirus. But as with cash, we can't necessarily see that improving anytime soon. It's the secured first mortgages, I think, where a lot of clients have questions around what are we seeing, what's coronavirus doing to their mortgage investments, and I think it's certainly worthy of a bit more detailed discussion. Diversification, as we've said a few times during this presentation, is key, and really even within the secured first mortgage space, we're always looking to diversify a client portfolio. So any portfolio might have 1, 2, 3, probably even more than 3, 4, anywhere up to a dozen or more individual secured first mortgage investments in their portfolio, and on average, as I said at the earlier in the presentation, they're generating around about 6 to 7% income for the investment period. Now, talking generally, we keep in very close contact with our secured first mortgage providers, because we want to keep our finger on the pulse. We want to be aware of what they're seeing. Are they seeing difficulty in the mortgage space? And I would say, generally speaking, we're seeing around about 12 to 15% of secured first mortgages across the board being in some form of difficulty. Now, difficulty could be payment deferral, where the borrower is unable to pay the interest on their secured first mortgage investment or the secured first mortgage loan due to coronavirus. It may be that their business is suffering, so they can't pay their debts. They may be on JobKeeper, JobSeeker, so they're undergoing some form of difficulty. So they've applied for a payment deferral with the mortgage provider. Generally, a payment deferral will be for around about 4 months. So there may be a period of for 4 months out of a mortgage's lifespan where there is no income coming through. And I think, as dire as that sounds, I think it's really important to point out the diversification aspect, because with 12 to 15% deferrals across the mortgage board for a client portfolio with a dozen or so mortgage investments within that portfolio, there may be 1 or 2 or maybe even 3 in an extreme example where there is no income being paid for a period of time. Now, this doesn't necessarily mean the investment is a failure. We're still very confident with the capital of clients' capital being secure, but we may find that across the board, the overall interest rate on a secured first mortgage section of the portfolio is lower because 12 to 15% just aren't paying interest for a period of time. But as I said before, it's very important to stress that the capital that's invested in these mortgages is still backed by a property. As I said before, often with a 60% or 67% maximum lend. So we've still got a very healthy security buffer there to protect our investors if ultimately push comes to shove and a borrower can't continue making interest payments on their loan. Ultimately, the property is taken possession of, sold, and that's where we really rely on our conservative loan-to-value ratios.
Thanks, Simon. And when we look at property next, we've seen a huge range of impact on property. I mean, some properties have increased their rental income that you're receiving, others haven't, and others have actually had to provide rental relief to tenants. So, as we know, especially here in Victoria as well, this is very, very strange operating conditions, and we find that business patterns are heavily affected, which means that they have requested rental relief on occasion of the property manager. Now, this next point is really important as well, where the right property is often found by a great manager. And we deal with some amazing property managers. Now, because they're doing this all day, every day, they're the ones that are coordinating the rental relief if it's been requested. So it's not just someone asked for it, so they get it. There needs to be proper grounds for it, so that they're doing all the right things by both the tenant to make sure that they can stay in business, but also the investor, because at the end of the day, you're the ones investing in this property. So they're doing a great job of making sure that they're all on great terms with the rental relief. So once again, as the state starts to open up, we'll probably find that the Victorian businesses will be able to start trading a bit better, and these sorts of rental relief requests will definitely slow down and get back to normality. But to the diversification piece, the reason why we introduce a number of properties is, as I said before, it's definitely not across the board that they're seeing this rental relief. We've even seen some that have increased their distribution. So getting a good, healthy mix of different types of properties is really important as well. So with shares, the Australian and international shares, well, mainly this comes down to Australian shares because we're speaking about income. And as Simon said before, Australian shares tend to pay a lot more income than international. But once again, we're seeing trading volumes decreasing and a big impact to the way businesses are operating, which means that they're generally speaking getting reduced profits this year than what they would normally see. So that's impacting dividends, because if dividends are a reflection of the amount of profit a company is making, then that's what we're seeing there as well. We're seeing some slightly reduced dividends. We're seeing some of the major banks say, look, their half yearly one, they might just stop that one for this round and do their full year dividend later, or all those sorts of things. Now, it's not just reduced profits that's having an impact on reduced dividends as well, though. It's actually balance sheet health. When a company, even if their profit hasn't been overly disrupted, they might still make the decision to reduce dividends to just make sure they're holding a bit more cash than they normally do, because we're obviously in very strange times and we've never been through this before. So they just want to make sure that they all come out the other end of this okay and they can continue trading. So while, of course, we really want to make sure that the income is still reliable and steady, we do also support the idea of making sure that everybody gets through this, because once again, shares is not just about income, it's also about the capital. And if they kept up their dividend payments, but it meant they had to borrow money to do so, well, that's not good business. So we're in full support of making sure that they can make it through this okay.
That's right. Now, just before we jump onto the next section, we've just got a question come through about the secured first mortgages. And the question is, are the secure first mortgages in a client's portfolio shared across other Hewison Private Wealth client portfolios? And if so, how many people are typically exposed to the one investment? The answer to the question is yes. Often many different clients will be investors in the one mortgage. Generally speaking, I mean, even just using some simple math, if it was a $1 million property, securing the loan at a 60% lend, well, then it might be a $600,000 loan. Average exposure of around about $20,000. So you may find there's 30 or so clients all investing in that particular mortgage. Now, we often find Hewison Private Wealth clients will make up most of, if not the entirety of a loan. Sometimes there may be other investors as well that aren't necessarily involved with Hewison Private Wealth investing in the loan. But generally, we like to have, I suppose, some control over the investment by having as many Hewison Private Wealth clients in the mortgage investment as possible. So what does it all mean for you, for the investor, for the Hewison Private Wealth client? I said at the start of the presentation that when we're constructing a portfolio, we have a very strong emphasis on income. Generally, we're targeting around about a 4 to 5% income yield on a portfolio. And then, of course, you get your capital growth, which could vary from 3% each year to match inflation, could be 4, could be 5, could even be lower than that if it's a bad year. But on average, you might get 3 to 4% capital growth, and that's what gives you your total return. Now, as Pierce and I've gone through each of the asset class, we've kind of highlighted where we might see the income reduce across those particular investments. Now that this is kind of a worst case scenario. I mean, we don't necessarily see the income on all the secure first mortgages being reduced, or we don't see the income on all of the property investments being reduced, but it is happening on a few. So we're probably seeing that while in ordinary times we might be targeting 4 to 5% income on a portfolio, we might see that reducing to around about 3 to 4% on average for a portfolio. Now, what does that mean? Well, it means that there's less income being generated over this period of time for the portfolio. But as investment managers, as advisors, we've always got a number of levers we can pull in the portfolio management space. Perhaps the most important lever that we rely on is the rebalancing strategy. And Glenn and Gladys took us through rebalancing and how we do that across client portfolios in our first seminar series. But perhaps the other, I suppose, protection mechanism for all portfolios is their cash allocation. And even though you might look at it and say, well, cash is earning 0.25% at the moment, 0.3% if we're lucky, why would we want an overly large allocation to cash? And we would generally support that. I mean, you don't want to have too much money in cash, but it is important to also have a cash buffer precisely for these reasons, because if we do go through a period like we are now, where the income generated by a portfolio is perhaps lower than expected, we can rely on our cash buffer and perhaps draw down the cash buffer. And ultimately, that means we're not in a position where we're forced to sell other assets, because it's really only when we sell the asset that's when we lose. Because if we're forced to sell assets against our want in a bad market or at the wrong time, that's a position we don't want to be in. So by rebalancing, by having a diverse asset allocation, by having a cash buffer that we can draw upon in times of need, that's how we can get through a period like this where perhaps the income is a little bit lower than expected. It won't last forever, and we're keeping a very close eye on all of the investments, monitoring the income they're generating, what's it looking like out into the future as best we can, really to underpin the portfolio with steady, reliable income, even during a period like this.
Perfect. Thanks, Simon. So as mentioned earlier, we're just going to come back to the case study a little bit for Sam and Sue and just see what it all looks like for them as well. And I guess, what our recommendations might look like in this sort of scenario. And I think it's important to highlight the fact as well, we're here to help people maintain their lifestyle. Could Sam and Sue change nothing? Absolutely. But we're not here to tell Sam and Sue, you need to go to bread and water because that's the income that you're getting. We're here to say, how can you utilize this asset base that you've worked really hard to generate so that it can generate the income that you need? So effectively, the financial part is taken out of your retirement planning or your lifestyle planning, and you can just keep living the life that you want. So it might look like we might say to Sam and Sue, well, you've got an amazing asset base there of $1.5 million, which is excellent, but it's not doing what you need it to do now. It's not generating the income that you need. So if you did realize the value of those properties and build an income focused portfolio, generating that sort of 4 to 5% income, that's going to give you the $60,000+ that you need every year without having to sell a single investment. It increases your flexibility because, as I said earlier, when you own a property and a large amount is in one asset, you can't, sell the proverbial bathroom off to fund that difference between the 37,000 and the 60,000. So it gives you flexibility because you've got way more access to capital. You'll reduce your risk. So the risk involved with owning 2 residential properties being your retirement asset base is you're completely at the mercy of the residential property market. Might be great, might not be, but you don't really have a choice in the matter. So diversifying lowers the overall risk. You've got steady and reliable income coming through because, as we've talked about a lot today, you're generating your income from a huge range of sources. It's not just coming from one place. So much more steady, much more reliable. And you've still got enough money invested in growth assets, so property and shares, that you're still going to be able to, over the longer term, grow your asset base to offset the effect of inflation.
Great, thank you, Pierce. Well, that brings us to a close of the presentation side of things. I'll open it up to any questions attendees may have. We've had a few questions pop through throughout the seminar that we've kind of tried to weave into our answers. But if there's anything you're not sure about, you're thinking about, feel free to pop it in the Q&A box on your screen, and Pierce and I will answer away.
Obviously, just in the chat box there, Stephen has also asked a question here as well. He's just wondering if there's any difference between the income distributed by an ETF versus a LIC. Now, what that means there is we're talking about the share space here, and an ETF is an exchange traded fund, and LIC is a listed investment company. Now, the range of ETFs has really expanded in recent years. What you traditionally have looked at ETFs for, exchange traded funds, is gaining a really diverse exposure to a certain market. So you can take an ETF out over an index, for example. So you might take it out over the ASX 200, the top 200 Australian companies. That's what an ETF can be. Now, it's developed to the point now where there's a huge range of them where some might reinvest dividends, some will just pay them out to you as income. So that there's a huge range there. With a listed investment company, that's basically where you actually buy shares in a company. For example, a really well-known one is Australian Foundation Investments. They've been around for a really long time. And their sole job as a business is to manage a portfolio of investments on your behalf. And there won't quite be as many investments in that as an ETF might hold, but that listed investment company will hold 30 to 50 investments for you, and they have a little bit more flexibility. So they generally do pay out a really regular and reliable dividend as well. But because they are in full control of that portfolio, they have the ability to reinvest some of the dividends if they feel the need to, and those sorts of things. So yeah, there's no sort of cut and dry answer to that, Stephen, unfortunately, but I guess there are so many different strategies out there for ETFs and LICs. I mean, some ETFs are passive, so it will be that top 200 companies. Some will be actively managed. So that active manager that is running that ETF might have a strategy where they don't pay out any income at all. They might reinvest everything, dividend reinvestment, we call it. So there's a lot of different ways to approach that. But yeah, i.e., there's options for everything.
That's right. Another question just come through from Mandy Laurie, just with the case study there, Pierce, with the the clients, they're selling their 2 investment properties for 1.5 million. Would they pay tax on that? Well, I mean, yes, you would assume they would, Mandy. We've tried not to include tax in the presentation. I mean, it can really vary on the individual circumstances. They may stagger a sale, they may have losses, but we just don't know. I suppose as advisors, tax is, it's always there. It's always an important consideration for investment decisions, but we can't let it drive our investment decisions. And that's where, as advisors, we're often aware of what the tax outcome could be. We're always working with accountants, and they're obviously the experts at determining what the actual tax outcome will be. And so while, yes, it does factor into investment decisions, we try not to let it drive investment decisions. But yeah, strictly speaking, you are right. It is something that the client would need to consider if there was any tax on the sell down of their 2 investment properties. Very good.
Right.
Any more questions coming through at your end, Pierce?
No, that's all I've got there. So yeah, maybe we'll just give it one last chance. But yeah, looks like that might be all the questions for today. And if anyone does have any more questions, though, anyway, obviously you can reach out to your respective advisor or just email either Simon or myself directly if you're not a client of Hewison's at this time. And of course, we'll come back to you with any answers for those questions as well.
That's right. Now, we said we'd be done in 45 minutes or so, and we're pretty much there now. So thank you, everybody, for attending today's session. As I mentioned before, this is part 3 of a 7-part seminar series. Next week, Andrew Hewison is having a conversation with WCM Global Investment Portfolio Manager Brian Huerta. WCM Global is probably a name many of you would recognise. It's an international investment that forms many clients' portfolios. So tune in next week for Andrew's conversation with Brian. Thank you very much.
Thanks, everyone.